This video will be the first of a three-part series covering various financial disclosure issues. Over the course of this video series, we will cover related party transactions, subsequent events, reporting for diversified companies, management's discussion and analysis, forecast and projections, and financial statement analysis. The first topic is related party transactions. These transactions are also called non-arm's length and occur when one party has significant influence over the other. When I was in college, my parents gave me a 1996 Honda Accord. The car was awesome, and I drove it for many years until one day the speedometer stopped working. I took it to the dealer, who told me it was likely an electrical problem and could be very expensive to try to find. Since it worked intermittently, their suggestion was to wait until it stopped working, reach forward, and bang on the dash really hard. I'm not kidding. If it started working again, that meant the connection issue was just behind the dash and they would fix it. Otherwise, based on the age and mileage of the car, they didn't recommend trying to find the problem. So I called my parents and my mom offered to give me her Audi. Yes, I was an incredibly spoiled only child. And then told me to sell my Honda to my cousin for $400. So my question is, was the Honda worth $400? Okay, so Annabelle would like to argue, basically, that anything is worth what someone is willing to pay for it. This is more or less the theory underlying fair value accounting, which we will talk about later in the course. But Chloe would like to point out it's not just anyone buying the car. It's my mom. Even though I was an adult by this time, she still clearly had significant influence over my behavior. I mean, she was going to give me a newer, nicer car, so I had incentive to keep her happy. So the general takeaway is that we cannot possibly know what the true value of the Honda was, because this was a related party transaction where I had incentive to do what my mom wanted. Another potential example of related party transactions comes from the major car manufacturers and their parts suppliers. Typically, plants that make auto parts such as fuel tanks will work with only one major car company at a time. The car companies can exert extreme pressure on these manufacturers to accept low prices because the factories are configured to make custom parts that cannot be resold elsewhere. For the parts manufacturers, having only one customer can create a related party transaction in which it's unclear what the true value of the transaction is. Whenever a related party transaction is identified, it requires additional disclosures: the nature of the relationship, description of the transaction, and any dollar amounts on the financial statements that are impacted. The next disclosure issue we are going to tackle is post-balance sheet or subsequent events. At the end of a reporting period, it takes time for a company to gather the necessary information and compile their financial statements. The time between the end of a reporting period and financial statement issuance is the subsequent events period. During this time, significant events that occur may require disclosure in the footnotes or recognition in the financial statements. Recognized subsequent events require adjustment to the financial statements. These events provide better information about an item already recognized on the financial statements, such as the outcome of an uncertain event that was estimated at year-end. Non-recognized subsequent events do not require adjustment to the financial statements, but sometimes require disclosure in the footnotes. These events should be disclosed when not doing so would cause the financial statements to be misleading. Consider a company that makes widgets and has one manufacturing facility. The day after the financial statement period ends, their manufacturing facility burns to the ground. As an investor, when you review the financial statements of a company, you are looking for information from a past period with the objective of forecasting future performance. If the fire is not disclosed, you might assume that the company can replicate its performance again next year. However, if the company discloses that their only means of producing widgets has been destroyed, then you will know that the company no longer has the means to continue operating at the same level of profitability as the prior year. Some subsequent events do not require recognition or disclosure. These are items that stakeholders are likely to learn about from other sources, such as news stories or press releases, and therefore are not required to be included in the financial statements. For non-recognized subsequent events, it can be hard to tell what must be disclosed in the footnotes, as this decision requires significant judgment. For the purposes of this class, you should be able to differentiate between recognized and non-recognized subsequent event and understand why not all non-recognized subsequents require disclosure. But you will not have to differentiate between non-recognized subsequent events that require disclosure and those that do not. Let's take a look at an example. Please take a minute to pause the video and jot down your answers regarding the income statement impact of these two subsequent events. When you're finished, restart the video and we'll walk through the example together. In this example, Moreland Corporation is preparing its December 31st, 2017 financial statements. Two events that occurred between December 31st, 2017 and March 10th, 2018, when the statements were issued, are described below. What effect do these subsequent events have on 2017 net income? So the first is a liability estimated at $160,000 at December 31st of 2017 that was settled on February 26, 2018 at $170,000. So they knew about this liability at the financial statement date of December 31st, 2017, but then they got new information about it during the subsequent events period. So the first question we have to ask ourselves is this a recognized subsequent event? And the answer is yes, because this is information about an existing liability that is on the financial statements, and had we had this information, we would have used it back then, because we were just trying to guess how much this liability would settle for, and now we know for sure. So we guessed before that it was 160, right here, and now we know for sure that it's 170. So the next question is, does this require adjustment to the financial statements? And again, the answer is yes, because it's a recognized subsequent event. So then the question is, what is the adjustment? So what we would have done on our financial statements is we would have recognized some sort of litigation expense. And we established a litigation liability. What our subsequent event is telling us is that the amount that we have on the books right now is short by the difference between that number and the actual event. So we're short $10,000 in our liability. So we need to increase our liability by $10,000. And doing so means we will recognize an extra $10,000 of expense. So we're going to go back and we're going to adjust our financial statements as of December 31st, 2017 for an extra $10,000 of expense, which means if we're trying to answer what effect there was on net income, the effect is a decrease of $10,000 because we're recognizing extra $10,000 of expense. So this is our answer to number one. All right, so then for number two, we have a flood loss of $80,000 that occurred on March 1st of 2018. So the flood happened after our financial statement period and during our subsequent events period. So the first question we have to ask ourselves is this a recognized event? And the answer here is no, because it's not telling us anything about something we were trying to estimate as of December 31st, 2017. So we had no way of knowing there was going to be this flood loss. We had no reason to believe any of our assets were overvalued because we didn't know this loss was coming. So here, this is going to be a non-recognized subsequent event. And because it's non-recognized, that means there will not be an adjustment to our financial statements, which means the impact to our net income is zero. We won't make any adjustment to our financial statements. So then the question becomes, should we disclose this? And yes, in this case, most likely, we should disclose it if it is material. If it's not material, then we might not need to. For the purposes of this class, we're going to assume that everything is material unless you're told otherwise. This concludes part one of our series of lectures on disclosure issues. Don't forget to email any questions you might have for discussion.